Okay, so hello everyone. Welcome to this macro overview. Just for the record, it is Sunday, May the 12th, about 7:30 p.m. It's taken me a while to get organized, and sorry there's no video. I seem to have lost my camera, so it'll just be my voice. Hopefully that's okay, and some charts. Okay, so basically last week we didn't particularly have any sort of major data. We had a couple of central bank decisions from the Riksbank and the Bank of England, both of which were leaning a little bit on the dovish side. But in terms of sort of other central banks, we didn't have anything. We didn't particularly have any Fed speakers. Well, we didn't have Jerome Powell, and we didn't have much data. So the market treaded water. But what we do have this week is some incredibly important data, specifically the inflation data. We get the PPI, which unusually is going to precede the CPI on Wednesday. And also on Wednesday morning, along with the CPI, we're going to get the retail sales. So this is going to be absolutely critical to sort of set the table for the next probably several weeks in terms of what the Fed's reaction function is going to be and where the markets will go. Just because at this point we have to just reflect a little bit on what Jerome Powell said after the last FOMC meeting, which was last Wednesday, and he essentially said that the two mandates of the FOMC, which is full employment and price stability or inflation, are coming more into balance. Now, what does that actually mean? That basically means that he's essentially said to the market that the probability or the possibility of hiking again, there was a very high bar. He said there was probably, that was not his base case. And so essentially what the market took away from that was this notion that a continuing sticky inflation would not necessarily lead to price sort of to hikes in the interest rates, but might just lead to interest rates staying at the same level for longer. On the other hand, any weakness in the real economy, specifically in growth indicators or employment, could cause the Fed to cut. So there's a certain kind of asymmetry at this point in the reaction function of the Fed. And we're going to get to pretty critical data points, as I said, this week. So what are those data points? It's going to be the PPI and CPI, both of which are expected to come in at about 0.3. If you look at the core number, 0.3 here on the CPI, and also on the PPI ex food and energy month and months 0.2. So they're the two key numbers. And then, of course, as I said, we get retail sales. So let's just look at what's priced in at the moment for the Fed, over the next, well, not over the next period, but just at the moment. And what we can see for the June meeting, there's only 1 basis point of cut. So essentially nothing at all is priced in for the June meeting. And if we go out to the end of the year, which is the middle of December here, you can see that about 41 basis points, or technically 1.6 cuts, is priced in. So the first thing we need to understand is that what happens if we get, let's say, sticky sort of inflation, and we get hotter than expected or stronger than expected retail sales. I think the key thing here is to look at is going to be, let's say, the 2-year yield. So let's just bring up the 2-year yield, because I think that's going to be the most sensitive one, and that's one I want to look at the moment. Now, what we can see from this chart here is that at the moment, over the last, let's say, week, with some sort of slightly softer data, slightly lower than expected NFP, the yields went down by, 20 or 30 basis points or so. But what's interesting is that at the moment, the effective Fed funds rate is about 5.33. And at the moment, the 2-year yield is trading at 4.87. Now, of course, the point is that the 2-year yield encompasses all of the expected sort of action at the front end of the curve for the next 24 months or 2 years. And so if the yield on the 2-year were to rise up towards the Fed funds rate, which is up here, 5.3-ish, effectively what that's saying from the market is that the market does not expect the Fed to cut at all in the next couple of years, which is a pretty aggressive kind of point of view. So what I'm thinking here is that if we have kind of hot inflation data confirmed, let's say, or reinforced by hot PPI and hot retail sales, for sure, this yield on the 2-year, which is going to be most sensitive to the policy change, that could go up, 25 basis points or 20 basis points or so, and could get back up to these levels around about, sort of 507, 508, 509 or so. But that's probably some kind of cap, because to go further than that, higher than that, effectively says that the market does not believe that the Fed will cut at all, as I just said, anytime in the next 24 months, which is getting to quite extreme levels. So the first thing is to say that, it will probably run these stops if we get hot data. But then I think around this level, anything from about, 506, 507, 508, 509 in terms of percentage. I think actually it's going to be a bit of a cap, and that could be an attractive entry point to buy, let's say, ZT futures or the 2-year bonds, or maybe even something like SOFR contracts, Z or December 2025. That's definitely going to be quite an interesting one. The other thing here is that, if, for example, we get a cold number, of course, I mean, the first thing is that this yield will probably go down again, at least maybe 12 or 15 basis points, something down here. And we'll probably get some bull steepening. And the other thing as well is that if we get a soft number, I think what we'll see is that for the June meeting, which we saw here, the possibility of at least half a cut being priced in, so about 12 basis points will enter. So this number will go from -1 to maybe minus 10, 9, 10, 11, 12, something like that. The other thing which I think is going to be very, very important is that the yield curve is going to change. So if we look at, let's say, something like the 2s to 10s, which is a bit of the sort of the classic one, so to speak, I think what we'll see if we get hawkish number, we're probably going to see that we'll get some kind of sort of bull flattening. It'll flatten probably down to, down here, bull flatten quite a lot. And if we get something which is sort of a cold number, that was probably going to sort of bull steepen, probably somewhere up to here, about minus 16 basis points or so. But so that's what I think is going to happen. And now the other, so we're going to, so what is interesting though is what happens if we get, let's say, for example, in line or just a slightly hot CPI, and let's say, for example, we get a weak retail sales. Now, in this scenario, the 2s will probably outperform the rest of the curve. And why is that? And this is where it becomes very important to think about the reaction function of the Fed, because what the market is starting to think is that in terms of the mandates, the twin mandates of the Fed, Powell is maybe sort of saying, well, hey, I'm a bit more concerned about the real economy slowing down or employment situation worsening. And therefore, the market might think that the Fed is less interested in aggressively combating inflation. So in that kind of scenario there, what we might get is, let's say, a slowdown in the real economy. And yet we also have a paradoxical situation that the Fed is seen not to be overly aggressive in combating inflation. And that could get the attention of the so-called bond vigilantes, who might come out and say, well, hey, if the Fed is not going to be attacking inflation, that means that the term premium and the long end of the curve needs to go up. And we might actually start seeing some bear steepening there. So we might sort of see this really start to steepen pretty aggressively, based on this idea that the Fed is much more focused, especially in an election year, on one of its mandates, which is to keep full employment. So the point I'm trying to make here is that if we get, let's say, a 0.3 reading on the CPI core, and a significantly softer retail sales, the market may actually take that as being relatively benign for the front end of the curve, and might really punish the back end of the curve, which I think is quite interesting. So that's one there. Now, the other thing as well is that I think if we just look at, let's say, something like the 10-year yields, and the 30-year yields, I do believe that if we get some kind of scenario which I just outlined, that those yields do have the potential just to rise on an outright level in some kind of sort of steepening kind of way, just because term premium should go up on the idea that the economy is doing relatively well, and maybe the Fed is not as aggressive, as I just said, in combating inflation. So that's kind of interesting. So that's what I think is going to be happening there. Now, of course, if we get sort of soft data. So just to recapitulate, I don't know if that was sort of clear, but basically what I'm looking for is that if we get hawkish data, I think, yes, the 2-year yield could rise quite significantly, but I think it's going to be capped around here. And as I say, I think that's going to be an attractive entry point to start thinking about buying ZT outright. And also those of you interested in yield curve plays, I think when and if the 2-year yield gets to this level, that would also be an appropriate level to start thinking about entering, let's say, something like the 2s 30s, which may initially kind of flatten down, but then I think they would start to sort of steepen. So you want to be looking maybe at something like about minus 33 on the 2s 30s, or let's say on the 10s 2s, maybe something around about here, minus 40 or something like that. So the idea that would be to let the initial move take place, and then to look for an attractive entry point. Now, in terms of other stuff, if we go across to, let's say, when I say other stuff, let's go across to Europe. I mean, what we did get last year, as I said, we got the sort of Swedish, the Riksbank, which cut, and we also got the BOE, which, the key quote there was that they quote, could ease more than the current market had been pricing in. That was Governor Bailey. So we're starting to get this sense that at least over in Europe, and we know the ECB is thinking about, more or less definitely cutting in June, there is a little bit of sort of a cutting or an easing bias being pushed into the market. But, of course, all central banks globally will need the data to justify it. But nonetheless, I do believe that the situation will more or less mimic over in the German space what will happen over in the US next week with the data. So again, if we look at something like the Schatz, which is the 2-year, let's look at the 2-year yield on the Schatz. And again, I think if we do get some hawkish data, let's say, strong retail sales and strong PPI, strong CPI, a similar kind of situation that it could sort of push up towards, something like 3.12, 3.13, 3.15, kind of up here somewhere. But again, I think that's going to be capped. And again, I think that would be an attractive entry point based on this idea that, at the front end of the German curve, just like the front end of the US curve, yields cannot really go up too much more than the short-term interest rates because they're essentially going to be capped. So that would be an attractive entry point. On the other hand, the idea is that once they do that and once the cutting cycle begins, if we have dovish data as well, I do believe that the target will slowly start to sort of fall down towards, something like 2.7-ish, something down towards 2.68 there. So if we get, just to recapitulate, if we get hawkish, I think that would be sort of a buy for the Schatz when and if it gets up here. On the other hand, on weak retail sales and combined with, let's say, dovish inflation data, I do believe that the front end of the German curve could actually definitely sort of start to meander its way down towards, the 2.7 level as well. And I also believe that there could be a steepening bias over in there as well. So that's kind of interesting. One thing as well, just in terms of the bonds, which I'm looking at, I just want to look at a differential here. I just want to bring up, guys, just thinking a little bit about the euro and the yen. Take a little look here. This is for the 2-year. So this is the difference between the 2-year German and the Japanese 2-year yield curve. And you can see that it's essentially been range bound for the last, what's that? The last sort of six weeks or so. But what could happen is that, when and if the Eurozone and the US indicates, that we get some indication that the economy maybe is starting to weaken, and that they're going to start on a cutting cycle, over in Europe following the US. Could it be that the differentials between, let's say, the German 2-year and the Japanese 2-year, they start to come in a little bit, so they're not as wide at the moment? You're still getting a pickup of about 2.6% or so. But could it be that that will start to come in a little bit in favor of the Japanese bond space? And what I'm thinking is that, if we do breach this level, starting to get down here, something like about, 2.53, 2.55, something down there, it could drop, quite a lot more all the way down there. And I think that would be quite interesting at that point to be starting to think about maybe shorting the euro versus the Japanese yen. So what I'm trying to say is that I'll put it up here. So monitor the spread between the German and the Japanese yields. And again, just for example, I like to look at the 2-year. If that gets below, let's say 2.53, something like that, which could be up here also, just in terms of the currency, that would be an attractive area to maybe start shorting the euro. And again, we have some profit targets here, around about 164, then about 162, and eventually, a longer term down to 160. So that's definitely something which could be interesting. But again, that only works if you get signs of a weakening economy in the US and Europe, followed by, a definite signal that those central banks have entered onto a cutting cycle. And therefore, you might get some kind of central bank divergence or monetary policy between the Japanese and those central banks. Okay, talking about FX, let's just have a quick look at the dollar. I think we'll look at the dollar index. Again, I think this is going to act in a relatively classical way. At the moment, there's no reason to suppose that the US central bank, the Fed, will be less hawkish than other major central banks. So I think underlying everything, we have a US economy which is sort of outperforming more or less the rest of the world. Not perfectly every single day, but more or less that seems to be what's going on. And certainly the central bank in the US is a little bit more hawkish. So, but nonetheless, I think we're going to get a reaction this upcoming weeks. And I think if we get hot data, we could get up to, let's say, 106, 106.30, 106.40, this kind of area up here could be up there. But I think that would definitely be sort of a first target. And on the other hand, if we get sort of soft data, for sure, I think we could get down towards, like sort of a 104 area. So I think it's definitely going to be a reaction. That's probably going to move pretty hard and fast, on the algos, but that's definitely there's something to be looking at. And I think, at that point, if it consolidates around 104 or so, and we start to get a sense that the Fed is going to cut, and we get evidence that inflation is coming down, and that the data in the US is weakening. I mean, I think it could consolidate here for a little bit, and then maybe even test down towards the 102.50 or so. So I think there's no great mystery about the US dollar. You have to follow the data, and you have to follow what's happening with the inflation numbers, of course. Okay, so just let's have a look over at oil. Oil's an interesting one. Basically, if we bring this down, I mean, as you can see, we had a bit of a red candle there. Now we had the uptrend. We also had a sort of some moving averages here. We'll sort of throw that on, like I think we have some sort of moving averages. So quite interesting here on the simple moving average, we have the 100. That's going to act as a little bit of resistance. You see now, as I say, I'm speaking on sort of Sunday evening here, looks like it's opening a little bit lower. If that breaks, we could see that break all the way down to like 75.5. There was some chatter over the weekend that Iraq is, maybe not going to be supporting OPEC plus further production cuts, or then the oil minister of Iraq backtracked. But if we put this on, if we break this down to, let's say, a 4-hour chart, we can see that we had a pretty strong rejection here at the fib level, the 3.8 fib level. So if you look here and go, let me just actually clean that up for everyone. Okay, so if you look here at the fib, and I'm mentioning from this down impulse in here, basically at this horizontal resistance, this recent high, which also is a 38% fib, you can see that was pretty strongly rejected on Friday. And what we're seeing just an hour or so after the open here is that that's continuing to go down. So the bulls are under a bit of pressure here, and you've got to say that that does look as though oil wants to go down. And that's something interesting to keep in mind, because at this point, there's no, massive bullish impulse. And so I think at the minimum, we're going to trade in a range. And I think oil, the fact that it was rejected at that 38%, it could certainly, test. This is a nice level here, 76.84, 76.84. In fact, that is such a nice level. Just, I beg your pardon, I'm going to put that on my chart. So I have that permanently there. There we go. That's probably the next stop down. And then if it breaks through there, maybe that'll bounce a little bit. You're going to have to think that it could continue all the way down for quite a bit down to 75, 76. So oil looking a little bit under pressure there. Gold is going to be a very interesting one. Gold has been doing quite well over the last few days. So let me just find gold. Okay, so gold, I do believe, is going to act a little bit like the bonds, because I do believe that, let's say, for example, if we get a slightly soft retail sales, but we get, let's say, a higher than expected CPI, gold could go up to test, let's say, the 24.15 area, 24.20, this zone kind of up here, this kind of zone up here. And why would that be? Just because there's this whole idea that if the economy starts to weaken, if we get weaker retail sales, as I was mentioning about the 2-year bond, for example, will the market, the gold market, start to say, maybe the Fed's reaction function is a little more biased towards reacting to the slowdown in growth, and therefore less focus on the inflation mandate, and therefore that could be a sense that gold would start to become a hedge against inflation at that point, and a slowdown in the economy. So that's something which I think could be kind of interesting there. The other thing which is sort of interesting, just in terms of trading ideas, if you look at something like DBC, which is basically, oops, let me just put that up. This is something I'll be looking at. Now, the DBC, of course, is the commodity, general commodities, but quite heavily weighted towards oil and energy. And if we think that maybe sort of oil is, having a little bit of a sort of a range bound, or maybe even a little bit weak, could it be that DBC, as I say, which is heavily weighted, commodity basket, heavily weighted with energy, could underperform gold a little bit? And I just wonder, let me just see if I do actually have that on my ratios section here. I'm just going to have a quick look. Do I have DBC and gold? I don't. So I'm just going to put that in and put, let's say, GLD divided by DBC. Let's see what we get. Enter. Yeah, and as you can see, gold has outperformed the general commodity basket quite a lot. And could that sort of just continue? I mean, it's just interesting if we think that oil is not going to sort of perform super well in this environment. Maybe there's more sort of upside here of gold. Maybe long gold, will continue to outperform general commodities. So that's definitely something which is pretty interesting, which I'll be looking at. So just going back to, I just want to now look at the stocks, guys. Sorry, where do we go back here? Okay, so let's just look. First thing to notice is that the VIX volatility is down a lot. So anyone who's interested in sort of going long gamma or doing any hedging, this is a very propitious kind of moment to be doing that. But we also see on the MOVE index, which is the sort of general volatility index for the bonds, that also is down, not at lows, but certainly down. You can see, I think there's a quadruple bottom here. So you can see it's, certainly down at pretty low levels. And the thing here is that if the bond volatility is low, that encourages maybe a rotation into stocks, because the idea here is that maybe the bonds are not going to move massively, and that sort of at the margin is a little bit of a tailwind for the stock. So let's have a look at the stocks. Now, what we can see here on the SPX, it's kind of interesting, is that, in general, as long as inflation is not seen to be completely out of control, stocks in terms of nominal earnings generally go up and is seen as a bit of a hedge if you have a slightly inflationary sort of environment. And what we've seen, well, almost all the way through earnings season, we still have Nvidia and a couple of others, big ones to come. But basically, stocks are doing pretty well. They did have an opportunity to test down. I mean, the thing is that I'm just looking here. I just had a level here that they had an opportunity, let's say at about 5,200 last week. You see up here, there's this sort of horizontal resistance. Stocks here had the opportunity to be rejected, a little bit like oil, and to come back down. But the point is they didn't. And on the cash index, the SPX, you can see that stocks is trying to sort of retest all-time highs. So the chart to me is quite bullish. Like if you look, there's, that it hasn't violated any Bollinger Bands, any moving averages. This is just a shallow retracement. There's technically nothing at all which is bearish about this chart. There's nothing bearish about this chart. So anyone out there on Twitter sphere who's, saying, oh, stocks have to come off immediately, there's nothing in the chart to indicate that at this point. And the other thing I'm trying to say is that, let's say, for example, we get an inline or fractionally sticky CPI, but we get a strong sort of stocks, and we get a close, let's say, above 50 to 50 or something like that. Could it be that the stocks can push higher and go for a little bit of a sort of a measured move a little bit higher? I mean, I'm not particularly necessarily forecasting this, but just from a Fibonacci extension, maybe stocks indeed have another 1 or 2 or 3% a little bit higher, just from a technical point of view. And why would that be? Just this idea that it's not so much that we love stocks, it's simply that stocks on a slightly sticky inflation with a strong environment, economic environment, could outperform the bonds. So it's really a question of allocation away from bonds towards stocks. It's not necessarily that everyone loves stocks per se. It's just that stocks might outperform on a relative basis. They might outperform the bonds. So that's kind of interesting as well, is that maybe the equities will react more strongly to the retail sales than actually to the CPI numbers. So as I say, that if we get a sticky inflation, maybe equities are sort of okay with that. But let's say, for example, if we get a lower than expected retail sales, that could negatively affect the equity. So what I'm trying to say is that keep an eye on retail sales to get a sense of how that could affect the stock market. And I do believe that anything which is fractionally sticky in inflation but strong in retail sales, I think overall would be, even if we get a short-term sell-off in the equities, I think that's going to be a buy the dip kind of situation. So that's definitely something to be looking out for. The other thing I just want to look at, guys, just draw your attention, is just a very strong performance here in the European space. And I think you could see here that, Europe, is already retesting the highs in the FESX, in the Euro stocks. And I think, maybe, American stocks are considered a little bit expensive on a comparative basis. And I think definitely if the Euro stocks did have a pullback to, 48.50, 48.60 around here, that would be a great buy on dip kind of situation there. Especially if yields weren't getting too crazy and inflation wasn't sort of completely seen to be out of control. So that's definitely quite an interesting one there to be looking at. So I think that's about it, guys. That's about it for the moment. Again, apologies, this was a bit late, but I had a huge amount of technical issues with computers and all kinds of things this afternoon. So again, just to wrap it up, keep an idea, the key ideas, I think, is this notion that you have to look at the PPI and the CPI together. I personally will probably not be doing too much until we get the data at 8:30 a.m. on Wednesday. We get the retail sales, because I think really the way to look at that, again, just to recap, is through the optic of the two mandates of the Fed, and this notion that Powell seemed to indicate last week that he was a little more interested in sort of any signs of weakness in the real economy or employment situation, rather than a slightly persistent inflation. And he more or less led the market to say that he wouldn't hike anymore, whereas for sure he might leave those rates where they are for another few months. And that's the way to look at it. Now, talking about Powell, he is speaking, I believe, on Tuesday after the PPI. He's speaking to Klaus Knot, who's the head of the Dutch central bank, who's quite hawkish, I think, over in the Netherlands. I don't know exactly if he's going to make any comments, but for sure, every time Powell speaks, we need to be listening to him. And of course, that's just going to be an hour or so after the PPI, so he may give us a bit of extra color. I can't really predict anything there. What I personally will be looking out for is any sort of nuance or more detail about his reaction function. Again, this idea that he's not happy, but is not in the mood to hike if inflation comes in a little bit sticky. Okay, guys, so I'm going to leave it there. So thank you very much. Hope that was useful, and hopefully I'll get my camera working again in short order. Thank you so much. Have a great night.